Well, welcome everyone to the Queensland Branch RPGeo e-forum series for November. So on today's e-forum, mineral asset valuations. Our panellists are Mark Berry, Shaun Barry and Trivindren Naidoo. The theme is valuation of exploration properties. I'll introduce our first speaker, Mark Berry, who's a geologist with over 40 years experience working for small, medium and large organisations in the mineral industry. His experience spans exploration, feasibility and development, mine operations, management, research and development, consulting and professional development. He claims to have excellent project management and communication skills, which we'll find out about very, very shortly. His experience covers most commodities through coal and industrial minerals as well in almost all of the world, with the exception of, looks like Antarctica is missing. And for such companies as Newmont, Outokumpu, Pasminco, Syro, AMC, and currently as the director and principal consultant at de-risk Mining Consultants. He got his grad diploma in geoscience, mineral economics from Macquarie Uni in 1990, and his Bachelor of Science Geology from the University of Melbourne in 1979. So he's seen it all and done it all. Thanks, Mark.
Thank you very much, Peter, and welcome everybody. So hopefully everyone can see this presentation. So thank you, Peter, for the very kind introduction. I'll introduce our panelists, Trivindren and Shaun, in a moment, but certainly this should be a fairly relaxed and informal session. And I certainly really appreciate Shaun, who's representing SRK Consulting, and Trivindren, who is from CSA Global, to come along and volunteer their time and services to help along with this particular forum on valuation of exploration properties. The forum outline is, we'll just do a quick introduction, set the scene for some of the exploration valuations, talk a bit about the Valmin Code, seeing that's so critical to the whole process of valuation, certainly in the Australian context. Talk a little bit about some exploration property valuation methods, pitfalls and the pros and cons, I suppose. And all throughout, we can take questions and answers. So please feel free to pop questions in. Peter, as chair, will interrupt us as we're going along if you've got any questions. So at any time, please pass those questions along. I'll introduce our panel, and the first person to introduce is Trivindren Naidoo from CSA Global. Triv is the most junior member of the panel. He's got only 20 years experience, and as you can see from the biography and the picture, there's no grey hairs, at least not showing, and he looks very spiff in his jacket and suit there, and lots of valuation experience. Our second panelist is Shaun Barry from SRK Consulting. You can see that Shaun's just that little bit older. He's got a bit of grey tinge around the sides. He's up at 30 years experience. Again, lots and lots of valuation experience from a range of different backgrounds. And I'm the old grey bloke, 40 years experience, and certainly had the pleasure of Peter's introduction earlier. Let's think about now valuation of mineral assets. And just to be very clear about this, every mineral asset can be valued. Whether it's an exploration property, an advanced stage project, something in feasibility or construction, as well as in an operating mine, they can all be valued. And they're valued for a range of different reasons. You might be doing a valuation to support a stock or security exchange listing, mergers and acquisitions, fairness and reasonableness reports, investment decisions and financing decisions, compensations and capital reductions. And certainly it is considered by many a black art and not a true science, because there's a lot of judgment based on experience and market knowledge. And that's encapsulated in some of the requirements within the Valmin Code for making sure that practitioners and specialists involved in valuation have adequate experience to do that. Let's have a look at the typical progression of a mineral asset. This is a graph plot that many of you will see and have seen in the past. It shows the increasing value of a mineral asset on the vertical scale and the progression as you go from mineral exploration through prospect evaluation, project construction and mine production. And as you would like to hope, you would expect that the value of the asset rises during that period. Now, obviously, that's not always the case, particularly if the mine doesn't make a profit or anything else, then it's not always the case. But as a general progression, you're looking at that. We're focused in this area today. So we're looking at the valuation during that mineral exploration stage up until the point where you've really perhaps got reserves. And so there's a whole range of different valuation methods that might be appropriate during that period of time, and we're going to talk through some of those and the pros and cons of some of those as we go along. Just to give you a sense of some examples, this is an example of a mineral property valuation in a public report. This is one of Triv's valuations recently. It shows you that this is a gold property. You can see a number of project areas there, and you can see that the first one, Crown Prince, does actually have some mineral resources. There's some contained gold in ounces there, but the others do not, so they're exploration properties. And the valuation that you can see there is quite a substantial range. You can see that 1.85 million up to 10.25 million with a preferred range of 5.8. And that's fairly typical that you'll see in a public report. And it's just an example of one type of valuation. This is at the certainly the exploration end. At the other extreme, you've got here one of Shaun's valuations that he's been involved in. This is in South Africa, and so the currency here is the rand. You've got approximately 10-to-1 conversion between the rand and the Australian dollar. So the numbers there just divide by 10 to get the Australian dollar equivalent. Again, you can see a number of coal assets. These are residual resources in a project. And you can look at that and you can see the ranges, the lows, the highs, the attributable numbers for a low, high, and then a mid-range point. And again, you can see that there is quite a variation in the numbers, and we'll talk a little bit about why that might be the case shortly. Another extreme now, this is one of our projects. This is a very, very small project in Western Australia where the valuation is really quite minimal, you know, $100,000 US. So very small valuations, but they can still be generated, and you can generate those, the estimates using different techniques. So that's just three, you know, introductory examples of what you will see in public reports and in terms of valuation ranges for exploration properties.
Excuse me, Mark. Quick question from the floor, which probably helps set the scene from that chart. The definition of discovery, is it first ore grade or inferred resource?
Oh, I would think it's, in this instance, it would be the probably discovery drill hole.
Thanks, Mark.
So this point here, I would think, because certainly it's close to the inferred, so it could be, you know, both around the discovery and the initial probably release of inferred resources. So that they correspond there pretty closely. Okay, so for those of us and working in the Australian context, the Australian standard for valuation is encapsulated in the Valmin Code, which is the Australasian Code for public reporting of technical assessments and valuations of mineral assets. For those people who are preparing or reading independent expert reports, independent geological reports, independent valuation reports, then they're all written using the Valmin Code as certainly the Australian standard. And there are a number of international standards that are quite similar, but certainly in our context, then this is the Bible. And the JORC code still applies, and your reports are written with the JORC code in mind as well, but this is the particular standard that's used to control reports that deal with technical assessments and valuations. So have a read of that if you have not had a look at that. Some of the important basics to understand is this concept of value. And within the Valmin Code and most of the international standards, you have things such as technical value and market value, and they are actually somewhat different. Technical value is an assessment of a mineral asset's future net economic benefit at the valuation date under a set of assumptions deemed most appropriate by a practitioner, excluding any premium or discount to account for market considerations, whereas the market value includes the premium or discount to account for market considerations. And a number of exploration valuation techniques are looking at fundamentally a technical value, and some of the other techniques are actually looking at a market value, and you need to specify what type of value is being presented in a valuation report, and generally that's stated pretty upfront. Just to let you know that in the context of the Valmin code, you see this word practitioner. It's effectively the Valmin equivalent of a competent person under the JORC code, and the Valmin code defines practitioners and specialists, but ultimately a practitioner is the person taking the responsibility for the actual valuation. The other important thing to understand that the Valmin code sets out is that exploration and mining projects generally progress, and there are a range of different progressions in that stage. And Valmin sets out definitions of early stage exploration projects, which you can see the definition on your screen, advanced exploration projects, where considerable exploration has been undertaken and specified targets identified that warrant detailed evaluation, and a mineral resource estimate may or may not have been made. That then moves, as the project progresses, moves into a pre-development project where mineral resources have been identified and their extent estimated, but possibly incompletely, but where a decision to proceed with development has not yet been made. And so you've got these three, and these are the three types of projects that we're really going to be focused on today because we're at an exploration stage. However, the Valmin code also then defines a development project where it's obviously from the name, you're looking at a project where a decision has been made to proceed with construction or production or both, but it's not yet commissioned. And then you have production projects. Now, why this is important is because it's generally linked to what type of valuation approach that you might want to use. The Valmin code identifies a number of valuation approaches. There is a market approach, which is based on actual or comparable transactions, including joint venture agreement terms, and you're trying to generate a market approach based on things that are happening in the market, and as defined generally by that methodology, give you a market value. You also have an income approach, and an income approach is all around the expected benefits, usually in the form of income or cash flow that's measured through discounted cash flow or net present value type methods. And these usually require mineral resources and or ore reserves to have been defined. So there are only certain types of projects which are suitable for that particular technique. A cost approach is really based around the principle of the contribution to value through past activities. So how much money have you put in? How effective has it been? And using that approach to generate a valuation. The way that the Valmin code brings all that together is it shows you the stage of exploration. So we're in exploration projects or pre-development projects, development projects or production projects, where under the Valmin code, the expectation is that, for example, when you're looking at an exploration project, it's most likely that either a market-based approach or a cost-based approach is going to be relevant. It's too early in most exploration projects to use an income-based approach because you don't have mineral resources or ore reserves, except when you get to those advanced projects. When you move through to pre-development projects, then a market-based approach is appropriate, and in some cases you might be able to still use an income or cost-based approach. as you move further down the line into development projects and production projects, you can see there that the cost approach is no longer appropriate, because the amount of money you've spent on the project up until that point doesn't really have any linkage to the future value of that project. And so you're really focused in on market or income-based approaches in that context. So the Valuation Code also generally recommends that 2 different valuation approaches are used to look at a valuation, and where possible, you are certainly encouraged to make use of those 2 valuation methods, and that's in part because there's a lot of variability. There are a lot of assumptions in the way that valuations are done, and so it's good to use different approaches to come up with a valuation on a project, and then look at why they might be actually giving you different numbers. Okay, some examples of valuation methods. Here you have the various approaches. So there's a cost approach, an income approach, and a market approach. And some of you will be familiar with the various types of methods and what they're used for. So for example, under an appraised value methodology, you're looking at meaningful past exploration costs and budgeted or projected future costs to arrive at a value, again, on the basis of what's the useful value of the expenditure you've incurred to date. Historical costs, incurred cost less any outstanding obligations and or depletions. There are a range of income-related valuation methods that you can see here. Typically, the net present value, the discounted cash flow methodology is a very commonly used approach. Gross contained metal value. You can see statistical and probabilistic methods, as well as decision tree analysis methods to look at. Under market type approaches, you've got comparable transactions, and we'll talk about those shortly. Market cap per ounce, market cap per annual production ounce, option agreements, geoscience factors, and rules of thumb under those approaches. So there, as I said, there's a wide range of approaches to choose, and within approaches, you've got a range of different methods to use. Let's look at the type of projects that we're really going to focus on today, and we'll talk through some of the thinking. And certainly, as I said, there's lots of discussion, and there's certainly lots of conjecture about what the most appropriate methods might be at various points along the scale. But certainly you start with an application for an exploration tenement, and it'll be interesting to talk to Shaun and Triv about their views on whether or not an application for a tenement even can be valued or has any value at all. And then you progressively move through further and further exploration activity. So you might have the tenement has been granted prior to commencement of any activity. You've got some activity, you're moving through. You've even got tenements where you might have lots of activity but fairly disappointing results. So even those tenements you can actually value. Tenements with exploration results showing some targets, potentially economic drill intersections, moving up into exploration targets that you've identified based on the work completed. Eventually you'll get to an inferred mineral resource, and a mix of inferred and indicated mineral resources. And it's at that point, you'll be doing things like pre-feasibility studies and potentially conversion to probable ore reserves. So that's certainly, we don't really want to get to that, quite to that point, but that typically shows that progression. So what I want to do now is bring in Shaun and Triv, and I'm certainly going to give you the chance to also ask any questions about any of that. I'll start with Shaun. Let's have a look at the first dot point, an application for an exploration tenement. In your mind, does an application have any financial value at all?
Yes, we can put a value to an application, but we'd obviously apply a discount to it we're doing comparable market transaction method, for example, as you mentioned earlier, you may want to apply a discount based on the uncertainty that you'll actually convert that application into tenure or ownership of that tenement. But yes, you can value an application.
Okay, Triv, what's your thoughts on that?
Sorry, we've had some discussions at CSA around this, and I think it essentially comes down to a case-by-case basis. Yes, there is value, but how much of value can be debatable. And one of the big influences on that would actually be jurisdiction. How secure a form of tenure is an application as opposed to a granted tenement. So in some places, there can be several competing applications, and you wouldn't really know which one is likely to be granted, whereas in others there's much more robust procedures and timelines and so on around, where you can be fairly certain that if you're the first person to put in an application, there isn't going to be anyone else that's going to get it granted before you, and those would have different values. But as Shaun said, we'd normally look at it and make the assumption that it's been granted. What would you then value it on the sort of technical merits, and then based on jurisdiction and other, figure out what a reasonable discount is. You know, and that could be anything from 30%, 50%, 70%, just depending on your view of how likely it's to be granted and whether the full area is going to be granted, or you might be granted a subsection of what you've applied for.
So when you're looking at, and this again to both of you, when you're looking at an application for an exploration tenement, how much does the proximity or the nearology to significant other tenements influence a valuation on an application?
Well, I think like Travin said, you would look at it. Your first step would be looking at that application as if it was granted. So you would then apply the same factors as you would in terms of neurology, geology, infrastructure, all of those sorts of things as if it was granted. And then you would apply a discount to it because there's this lack of uncertainty that Travin mentioned. To that value you've come up with.
Okay, so it is contributing.
Yes, absolutely. As if it was a normal tenement that was granted.
Okay. What I might do now is we'll go back and touch on a couple of issues before we get going to talk about some specifics. But one of the obvious things that people point to when it comes to valuation is the quite large valuation ranges that often get assigned to exploration assets or mineral assets. And I've only just shown this one because it's yours, Triv, and I will ask you first. This has got, if you were comparing this to, say, a real estate property, a commercial real estate property, you've got a preferred valuation of 5.85 million, but basically you've got $4 million either side of that. If you were looking at perhaps a real estate valuation that had a preferred valuation of 5.85, you might be looking at 5 to 6.5 or something like that. The range would be typically a lot less. What's the key factors that contribute to this wide range, and you see them in the vast majority of exploration valuations?
That's a big question, but I guess a simple catch-all there would be a uncertainty. So the fundamental value for a mineral asset is geologically driven generally, and there's always uncertainty in interpretations of the geology, and whether or not a mineral asset can actually be economically viably worked. Can you actually make money from mining this thing at the end of the day? And you're heaping risk upon risk, uncertainty upon uncertainty, and trying to look through this. Now, most of the valuation opinions that you're asked for, mostly it's a market value, and you're trying to figure out what's a reasonable price that someone could pay for this. But different buyers and different sellers have, different things that they would consider valuable. So there's always going to be a large range in this. If you compare that to a real estate valuation, there's the true range in what you're going to be able to sell it for is a lot less, because there's a lot less risk and uncertainty in there. You can see the piece of land, you can see the building. It's not necessarily so much in future potential.
Okay, thank you for that. Shaun, would you like to add anything, comments? Because I know that you've got a lot of experience in real estate as well, or real estate valuation methodologies.
Not a lot of experience in valuing real estate, but I have had a stab at it, yes. But I think just to add to what Trivindren is saying in terms of mineral assets, mineral properties, one way of looking at the variation in uncertainty, obviously something with an inferred resource, we would apply a much larger range in that value, as opposed to something with a measured resource. So there, measured resource, you've got greater certainty of the mineral resource being in the ground, as opposed to an inferred resource. And from experience, commissioning entity that commissions practitioners like ourselves to give our view of the value, have started to question ourselves in terms of that range, and have limited us from saying, okay, you can't be more than about 3 times the lower limit. Let's stop there at 3 times the lower limit, and then bring it in. And when you get to a measured resource, something maybe like a 2 times the lower limit, as a more practical range. And so just being consistent is what I'm suggesting, or what the market is suggesting us to be.
All right, no, that's really good. I appreciate that. I'm going to flicker through a couple of slides, because I just want to follow up that with this a question relating to ranges. Do any of these methods typically lend themselves to delivering a value with a smaller range than any of the other methods? Or do you see that wide range in valuation cutting across all of the methods that we use to value mineral deposits? Start with you, Shaun.
Yes, I don't think it's about the method used. It's about the geological information, the mineral resource, the infrastructure, those factors that contribute to the value, rather than the method that you use to come up with the value. So that the ranges apply across all those methodologies, the same across all those methodologies, but the range is driven by the uncertainty of the factors that add value to that mineral asset.
Okay.
I don't know if you've got anything to add to that.
Well, I guess I agree with what you've said there, that you'll see a range in everything, and it's meant to be driven by the underlying asset more so than the method you'd use. And there's different ways of applying the various methods as well. But having said that, just sort of empirically from applying different methods, generally I tend to see a larger variation in the market methods or the market approach to the other approaches. And I guess it's because it's empirical data. You've got some stuff selling low and some high. And the challenge is always trying to figure out what that means for what your opinion's going to be.
All
Yeah, I
right.
think the market-based approach, you're taking a data set of let's say it's gold tenements in Western Australia, and you try and compare them, and they're not always comparable, and so you get a lot of variation in the, let's say, dollar per ounce value of a gold asset, and that's depending on whether the transaction took place because of a strategic purpose, or whether it was close to a mine or infrastructure, whether it was on different geology. It's hard to find comparables, and so you get a wide variation, as Trivindren says, and it's often hard to get a narrow variation, to find a narrow variation in values, simply because of the lack of comparability.
That's actually a really good lead into the next question, Shaun. What I was going to prompt for both of you now is just to talk about a couple of the more common exploration valuation methodologies, and just be able to get some thoughts about how they're done and the benefits and pros and cons of them. But if you could just provide a very short explanation of the comparable transaction methodology. And then I'll get Triv to talk about the geoscience factor methodology, which is also a very common exploration methodology. So, Shaun, could you just provide a short summary of how comparable transaction approach is actually done?
Yeah, so as we have in the table there, it's a market-based approach, and there's various there's variations in it. You can look at the actual transactions taking place of a buy and a sell of, let's say, a gold asset as an example. A tenement could be a prospecting license or an exploration license, and you can either do it on a dollar per square kilometer or hectare basis, so a dollar per area for the very early stage exploration assets, or you could do it if there is defined resources, then you can do it on a dollar per ounce basis or equivalent ounce basis, and then compare a data set of transactions and find comparables to work out a minimum, maximum, average or weighted average or a median, and that data set you would use as a basis for the valuation you come up with for the asset you're trying to value.
And so when it comes to commodities such as gold, that and certainly in Australia, that's forms a very good data set, because there's generally quite a lot of potentially comparable transactions. So what happens in the case of quite more less frequently traded commodities? Let's say if we were looking at a rare earth deposit,
yeah.
How does that particular method deal with situations where there is very few actual transactions to look at?
Yes, so that is that becomes a major difficulty, like exotic minerals like tungsten and titanium and graphite and things like that. They don't trade those tenements very regularly, and then you've got to look at another approach. And if there aren't any market transactions, then possibly you go to the market method approach. I see you've got the rule of thumb there. That is another market method that you could use, and that is based on a set of if you take the market price of graphite, for example, as $1,000 a ton, as by way of example, then you would look at the value of that resource of graphite in the ground, maybe at for a measured resource between a 1% and 2% of that spot price at the time, the market spot price at the time. So that would be $10 or $20 a ton, for example. You would apply those metrics to the resource and value it that way. So that's one way of doing it. Otherwise, you'd have to use a cost-based approach to value those tenements if there are no market transactions at all.
In terms of you'll hear regularly the use of the word yardstick values. Where do you normally see those as? So are they part of comparable transactions? Are they part of rules or rules of thumb? So where do the yardstick values come from?
So yes, yardstick and rule of thumb are one and the same method, and we have a basic set of table set for valuing those. So as I was explaining earlier, for measured resources, you would look at 2 to 5% of the spot price of that commodity. Indicated resources, you would value between 1 and 2% of the spot price. Inferred resources, you would value between 0.5% and 1%. That's that range we were talking about earlier. And then if there was only a target and you could establish a target on that tenement, then maybe only 0.5% to or 0.1%, used as that range for valuing that tenement. So yardstick and value rules of thumb I see as the same method, just two different terms.
All right. So I might move over to Triv. Geoscience factor is used a lot in exploration valuations. Could you just provide a summary of how that approach works?
Yeah, sure. Just informally. My first observation is in this one, Lilford has put geoscience factors as a market method. There's a school of thought that says it's rather a cost approach rather than the market approach, and I tend to agree with that rather. And the thinking there being that the method is based on your knowledge of the tenement as it is, and that knowledge is often based on work that you've done or that others have done. So, and not really anything to do with the market. So that's my sort of first point there.
That's good.
So what it's based on is it's essentially a technical valuation of the ground based on looking at 4 specific factors and rating them. And that's off-property factors, essentially nearology, neighborhood. Are you close to existing mines? Are you along strike of a known resource? Things like that. How does that affect the value of the tenement that you're looking at? The second one is on-property factors, similar, as in, are there previous gold workings? Historically, has someone found something there? This kind of aspects that you're looking at. Then there's what's usually referred to as anomaly factors, which tends to look at more specific exploration that you've done. Have you generated a geophysical target that needs to be followed up? Have you done a lot of soil sampling and the results are positive or negative? You consider those. And the last factor is geology. Does the tenement that you're looking at actually have prospective geology? Is there prospective geology actually undercover? Or are there structures going through that could be of interest? So you rate the tenement using these factors. But before that, I guess you start with what's called a base acquisition cost. And the concept of that is the average cost to identify, apply for, and hold the average piece of tenure in the jurisdiction that you're looking at. So that your valuation is based purely on prospectivity and not on differences in jurisdiction. So once you apply all of that, you'd end up with a technical valuation, and at the end, you've got to use a market factor if you want to make that into a market value. So there's a bit of guidance as to what goes into a base acquisition cost and how you'd go about that. There's very little guidance in the literature as to where this magic market factor comes from. And different practitioners have different ways of doing that.
So in terms of, just to follow up on that explanation, which is great, thank you for that. Obviously, there's lots of subjectivity involved in those assessments, and individual geologists will have their own views about prospectivity, for example, or whatever else. So I'm guessing that, as is the case when it comes to having a group of geologists talking about interpretations, then if you had a group of geologists involved in doing a valuation of a property using exactly the same methodology, such as geoscience factors, then I'm still guessing that there's going to be the potential for quite a lot of variability in that resultant valuation. Is that correct?
It is, and partially to alleviate that, if I can say that, they usually, when you do a valuation based on this, you'd put your rating schema out there, as in a table saying for each of the aspects that you're looking at, what would you rate it if it was X, Y, or Z? So, for example, you'd say on the off-property factor, if you're along strike of a world-class mine, I'm going to call it a 10 multiplication or a 5 multiplication. And you know, if there's nothing in the area, then there's no multiplier on that. You know, it's a 1, something of that sort. And you'd as part of the valuation, you'd publish that table so that someone else can take the same table you've used and look at the information that you've provided and see if they can come up with the same valuation. And that sort of leads me to another point that we haven't discussed, but I think it's an important one with valuations, is the Valman Code refers to public reporting of technical assessments and valuations. So all valuations, I would suggest, should be based on a technical assessment, and that assessment should be part of the valuation report. So you could actually see what information has been considered in coming up with a value for the property, and it's your opportunity to essentially say why you think those aspects are important.
Okay.
Excuse me, Mark, just a couple of clarifying questions from the floor. Luke Jordan asks if you can repeat what the rule of thumb was for measured. Was it 5%? Was that the value?
Yes, that's right. So the range for measured resources, is between 2% and 5% of the spot price of that commodity you're trying to value.
Okay, thanks, Shaun. And another one from Deb. Doesn't that yardstick percentage depend on the type of commodity? Bulk commodities or minerals requiring downstream processing may have different yardstick values to those that can be sold on based on spot price.
Yes, and so this approach doesn't always work well across commodities. I think it was sort of designed more for precious metals and things like that. And so when you get to bulk commodities, the methodology falls down.
Thanks, Shaun. That's all from the floor at the moment.
Just in terms of follow-up, so first of all, to Triv, is there any particular valuation methods that you either like to use as a preferential methodology, and conversely, are there methods that you really do not try to use in an exploration property? Let's say if we consider properties that do not have any inferred mineral resources at that point. So just, do you have any preferred methodologies for those type of projects? And for example, conversely, very much non-preferred methodologies. So we're effectively excluding the income-based approach. So we're looking at either cost or market-based approaches, but within those two approaches, do you have any favorites or least favorites amongst those methods?
So I would generally try to apply a comparative transactions approach to just about anything, give it a go at least, to see what it says. That's for a market value, it's hard to argue against seeing what the comparative transactions are like and what they're suggesting the property might be worth. And in terms of least preferred ones, when you're looking at the value of a specific property, and so you're doing an asset level valuation, I dislike things like EV per square kilometer, which I've seen applied and can be done. But once you're looking at things like enterprise value or market cap, you're comparing companies, which isn't necessarily the same as the underlying ground. Because EV would take into account things like corporate structure, what the market thinks of the management, the company's ability to raise funds, etc., which has nothing to do with the underlying ground, really.
Okay. Shaun, your take on that question?
Yes, absolutely. I agree with Travin in that case. So Travin is talking about a peer group analysis, which is market-based, which is what share prices of exploration companies are trading on the stock exchange, and they may be exploring for a suite of commodities. So it then becomes difficult to compare. But what as mentioned earlier, the yardstick approach is something I only ever use as a guide because of the question, the person who put up that question. And for that very reason, that it can fall down when you go across commodities as well. So I only ever use it as a guide. I prefer to use market transactions or joint venture terms as a valuation method. And I like to back it up with the geoscientific factor method because it has an applied methodology, consistent applied methodology. And if it comes out close to comparable market transactions, then it gives me comfort that I'm on the right track.
And the methods that you would try to steer away from?
So certainly I try to steer away from rule of thumb or yardstick methods because, as I said earlier, they can fall down when you're walking across commodities.
And the cost approach?
So I agreed with Travin there that his earlier comment, the geoscientific approach to me is a cost approach because the base acquisition cost,
okay. Yep.
Your starting position is a cost of holding that tenement. So it falls into the cost category. And it's a good method because it's consistent methodology that you can apply.
And in terms of the appraised value or the historical cost methods, are you a fan of those type of approaches?
Yeah.
So we've just lost you, Shaun.
Sorry, those approaches are backward looking. They look at the historical costs, and the premise of those appraised value or multiples of exploration methods, you look at the historical costs over the last 3 to 5 years, you escalate it to today's terms, money terms, and then you apply a market-based factor to it to sort of to bring it to a market value. And the premise of that is before you've actually found a tenement with any resource, a defined resource on it, this is the methods that you would be left with that you could only do. The problem with that is because it's backward looking. It may not have any direct implication to the actual value. The premise is that if you spend money, the investor has a right to a return on his sunk funds or invested funds into that tenement. And that premise might not necessarily be the market value of that tenement in the marketplace.
Okay, thank you for that. Peter, do you want to just run through the last couple of questions?
Yes, Mark. These are fairly general, but quite important ones. First one I've got here is from Pete Findle, and someone's upvoted, so obviously there's a few people keen to know the answer. How do you deal with difficult jurisdictions like DRC or Iran for a project with indicated and inferred mineral resource, or a project with drilling results only?
So in that instance, I'm guessing we're dealing with an issue not associated with an application. It's actually a granted tenement. So yes, it's a really interesting one in terms of there would be almost certainly a discount that you would be looking at to deal with that. I'm not sure, Triv and Shaun, would you have a view on what that level of discount could range between?
Well, if I may jump in there, well, specifically the DRC, depending on a time window that you're looking at, you've got a fair amount of transactions, or well, not a fair amount, but you've got enough transactions to draw some conclusions as to what a market value might be. Mm-hmm. So you're likely to be able to use some sort of a market approach, and the discount only really comes in if you're taking a technical, if you're looking at a technical valuation and then trying to figure out a market value from that. So a cost approach or a geoscience factor or something like that. That's really subjective. And yeah, other than looking at historic transactions or something like that to try and figure out what the discounts were looked at, it's purely the valuer's subjective opinion.
In the case of, so with DRC, where there's quite a lot of transactions, that might certainly allow you to deal with the jurisdiction issues. But, if you then move to Iran, where I'm guessing there would be less transactions, you've got less input into what a market transaction might be worth.
So there, one approach would be looking at other jurisdictions that you would rate as having a similar sovereign risk profile. That would be one way of enlarging the pool of transactions that you could consider comparatives. Yeah, and I guess the other way would be to looking at things like sovereign risk ratings based on Fraser Institute studies or other sort of surveys, where it's not just one person's opinion that goes into it, it's actually a larger pool, and some of them have sort of quantitative measures built into those as well. So that's something to lean on.
All right. Peter, do you want to go through the next one?
Yeah, yes. Next one is from Tony Trudov. Because valuation is such a black art and varies so much in the eye of the beholder, especially for early stage projects, what is the use of valuations at that stage?
Well, as we indicated earlier, valuations are often used for a range of different purposes. So you may very well have companies who want to float on the stock exchange, and they will probably have done some valuations to get a sense of what the market might be interested in assigning a value to that company. Fair and reasonableness reports for, if you're buying and selling those assets, there will be often companies that are looking to trade exploration assets will want to get an independent assessment to help guide what they think is reasonable, and also they need to be able to substantiate some of the agreed transactions that to their own company investors or shareholders. So they will want to have some backup for the number that they pull out of the air. And often you'll have transactions that are agreed between buyers and sellers, and then they will then say, well, we do need an independent assessment to make sure that for the benefit of shareholders of both companies, that it is within a reasonable expectation or a reasonable range. So there is quite a lot of reasons why you actually do need those valuations at that early stage.
Thanks, Mark. Final question from the floor at the moment, one from Tafia Prasojo. Do you happen to know the business intelligent party that provides database of market approach benchmarks, historical M&A for all stages for gold? I'm assuming it's S&P's market intelligence platform. Are there others?
There certainly are others. Some companies maintain their own databases, and there are a range of different commercial companies that provide that service.
I know we don't advertise these, but do you know what some of those might be?
One of the AIG members.
Well, there's one called S&P Global.
Yep. Well, that's the main. That's the one that Peter referred to. But there's I've forgotten his name, but he's West Australian based, and he has a database of valuations.
Austex.
No, not Austex. They're Brisbane based. But I think
Austex. John Bell.
Yes, it is Jonathan Bell. Yeah. Thank you. So he certainly has some, and there is certainly some other smaller commercial companies as well. Probably not as big as S&P, but they are around. You just have to go looking for them.
Thanks, Mark. Another one popped in from Doug Brewster. With past cost valuation methods, do you ever take a component and rate them at a negative? All past exploration expenditures don't add value. Some expenditure devalues.
Absolutely. Particularly when you're using something like a multiples of exploration expenditure, you would potentially be saying that has added no value at all on the basis of the results. And particularly if you've got some exploration tenements that have been held for 10, 20 years and they've spent $10 or $20 million, but still haven't really come up with anything, you're going to be discounting the value of that historical work because it has actually delivered little to no value.
You also get the case of at that really early stage, the value that you're placing there is on its potential to host economic mineralization. So conceptually, you can get to the point where you've built up a really good drill target and the price has gone up based on that, and you drill it and it's negative. And at that point, you've actually destroyed value. So yes, certainly there's a case for negative values there, or negative multipliers.
And just extending on those themes, I guess, where you have projects, particularly in the hands of some juniors out there who like going back to those high-grade spots and drilling another hole to raise some capital, how easy is it to remove that kind of, sentiment as well as exploration costs from your models to come up with a realistic valuation?
So one of the ways, I guess, and it depends on how good the data that you've got to work with is, but if you can separate, and you usually can separate drill campaigns based on years or whatever, and the costs of those, and if you look at the results of each individual campaign, then you can put a prospectivity multiplier per campaign or per piece of exploration. So the first campaign where you've proven that you've got mineralization, and the campaign where you've then drilled it out to an inferred resource, those are definitely huge value adds. But if you go back and you do infill drilling and you know, you haven't increased the tonnage, you haven't really changed anything that you know, arguably that's not much value add. So you can work through that with enough information.
Thank you, Triv. Mark, we don't have any other questions from the floor unless you've got anything else.
No, and I need to disappear because I'm about a couple of minutes late from a JAWK code workshop. So please excuse me, but do you want to reshare the screen if you want to keep going for a few minutes, Peter?
No, it's okay. It is after 4, so we'll close it there. Thank you on behalf of the AIG to Mark Berry, Trivindren Naidoo and Shaun Barry. And thank you all to the participants who've taken the time out to come and have a listen. I see from the list there's quite a few people from overseas, so thank you very much. And if anyone would like to revisit this or share it with others, please head to the AIG YouTube channel in the next few days. On behalf of the AIG, thank you very much and good afternoon to all.
Thank you, everyone.
Okay. Thank you. Cheers.
Thank you very much. Cheers.